like to thank everybody for coming out this morning to our annual resources breakfast. This is something we've done now for about 25 years, and it's really changed in format, and it's certainly changed in the response, with the biggest turnout we've ever had today with about 380 people. So we certainly appreciate your coming out. What we hope to do today is give you some very practical, relevant information about what we do and what resources are available for you. You're going to hear from 4 of the team members to my left, Bobby, Nick, and Kale, as well as myself. We're going to talk about some of the new technology available to you, introduce you to the team, and really spend a little bit of time also talking about our process and our philosophy, because I think it's important that people understand how things are done behind the scenes, if you will, which is really the science of this, as opposed to the art, which is the personal vision planning, which we're going to talk about in a second. Now, when our company was founded in 1990, one of the reasons that I broke away from a regional firm to start our own is that it was very important to not just build capital for people, but also to build what we call social capital, to try to give back to the community. And our vision for the company is and always has been simply to make people's lives better, whether it's our clients, our team, or our community. On your tables, I hope you guys will all look at one of these annual reports, because a lot of what we're going to talk about today is in here. We're not going to read this to you because the information's in here. But this really does, among other things, talk about some of the philanthropic efforts that you guys have supported, which have made a tremendous difference. The initial effort was really focused on food, and to date, through donations that you guys have made, we've donated over 100,000 meals to people in Lake County, which is just phenomenal. On top of that, more than $200,000 has been donated. Now, in 2013, we started a new initiative because we found there were a lot of nonprofits in Lake County, and people simply weren't aware of what they did or who they were or what the resources were, either for themselves or their friends. And so we started something called Carver Cares. And the idea behind Carver Cares was twofold. First of all, to raise awareness of local nonprofits and what their missions were. And then second of all, and to a lesser extent, to support them monetarily. And so today's Carver Cares partner is PAWS Ohio, which is the Public Animal Welfare Society. And I'd like to introduce Amy Beekler, who's our executive director, and also one of her friends is with her, Mia.
First of all, I would like, thank you very much. I'd like to thank Randy and Carver Cares for having us out here. Thank you so much for your program of giving back to nonprofits. We definitely welcome and appreciate your support. I'm going to give you just a brief, quick history. PAWS Ohio has been a nonprofit since 1976. We rescue stray and abused animals throughout Northeast Ohio and even beyond. We rescue stray dogs and cats. We take care of their medical, their emotional, social issues, and we find them forever homes. The one thing, this dog here, and Sheila's going to kind of walk her around. She's a senior Adobe. Did anybody see the story last night on Channel 8? It was the lead story last night at 6 o'clock about the 200 dogs that were found in Adams County. And they were living in squalor. And 2 elderly individuals were caring for these dogs, and they were eating deer carcasses. That's all they had to eat for years. And We're an emergency placement partner for the Humane Society of the United States. So we were called in to try and help some of these animals. We have brought back 12 of them, and some of the most needy. This dog here, we have named her Mia. She's a senior dog. She's blind. She can barely hear, and she has a lot of neurological problems. But guess what? She's with us now. We will treat her no matter what it takes. And it's due to Carver Cares programs and their love for animals and their giving back to people like us in nonprofit that will get that done. I just wanted you to see a face of an animal that donations will impact. So again, thank you for having us out here. I appreciate it, Randy, so very much. Thank you all.
And you guys can get some more information on PAWS. There's flyers on the tables if you're interested. So let's talk about some of the things you really came out here for. It's interesting when people ask what we do. Sometimes it's a little bit difficult because our process is something that's really the antithesis of most of our industry. Most financial planning, investment firms, brokerage firms, they're very investment-centric. Everything's about the investments. Are the investments good? Are the investments bad? Our approach is very different in that we believe that the most important thing is you and what you're trying to do, your vision. And so we actually have a trade name registration on a process called personal vision planning. And personal vision planning is simply based on looking at what you need and what you're trying to accomplish, and then designing a holistic plan that looks at everything from taxes to estate planning to risk tolerance to near-term goals, long-term goals, all of those types of things, and developing a comprehensive plan that meets your vision. Now the thing is, because it's based on you, changes to the plan are generally made based on changes to you, not because of what's happening with the markets or the economy or some specific investment. And moreover, the most important thing with this process, again, is looking at what you're trying to accomplish. The investments really are just tools. And over the last 30 years, we've seen investment products come and go and change. But at the end of the day, we're still trying to accomplish exactly the same thing. Most people want to maintain or enhance their standard of living, and if possible, potentially pass on something to either charities or kids or family or someone else. And it's really not any more complicated than that. The problem is, everybody wants new and improved and exciting and different. And the fact is, this process, while it's relatively boring, is very, very effective. But it's very different what the industry promotes about, the market's up today, the market's down today, look at this benchmark, etc. So in our opinion, the only important benchmark is what we call benchmark you. Are you able to enhance and maintain your standard of living? If you are, then everything's good. All the other stuff's just basically noise. And so, as we go through this process, one of the things that's very important, it's one of the reasons we reach out for reviews so much. It's important for us to understand, what you're thinking about, what your needs are, what your wants are, and what's changing in your life. And that's why the periodic reviews are very, very important. At the end of the day, there's only 3 reasons we're going to recommend a change to the portfolio. 1, if something changes with you. Suddenly you win the Powerball. Or you need a bunch of money for a trip or a vacation. The second reason would be if the overall asset allocation gets out of whack, typically because something did very well. So now we have too much in one thing, we want to rebalance it. Or the third reason would be if an investment's not keeping up with its peers or the appropriate index. Now, one of the things Gail's going to talk about in just a few minutes is our process for evaluating the investments, what I would call the science. The art of this is really coming up with an allocation that meets your needs and your vision, minimizes taxes, minimizes expenses, deals with the things we can control, while the science is the investment selection, monitoring, and updating. And we have a proprietary process that nobody else at Raymond James uses or anywhere else. One of the things that I think is important to keep in mind is something called recency bias. This is where the things we think about the most tend to reflect what's happened to us most recently. So for example, if you're running down Route 2 and you go past a speed trap, the next time you go down Route 2, you're going to think, oh, it might be a speed trap. It's going to influence your behavior, more so than if you saw that speed trap 10 years ago. So a lot of times when people look at whether it's the markets or their portfolio, they're basing their decisions and their perception on what's happened most recently. The problem is that's kind of like driving down the road looking in the rearview mirror. It's great as long as the road's straight, but once it turns, you're going to have a problem. And so some of the assumptions that are made, I think, are based on previous generations or previous experiences that may not be applicable. And I'll give you two specific examples. When I started in the industry, the typical person worked till 65 or 66 years old. And then they retired. And they typically live 4 to 6 years in retirement. On average, people die in their early 70s. Well, now, people retire at 55 or sometimes even younger, and they're living forever. They just don't die. And so you have a situation now where people could literally be retired longer than they worked. Well, that requires a much different set of planning than what our parents did, because their risk was, boy, I don't want to lose money with things going up and down. The risk that most of us face is, I don't want to outlive my money because inflation's picking up, things cost more. And the question I've asked for 30 years, and I'm going to ask it again because I think it's as applicable today as it was in 1987 when I first asked this. How many of you guys paid more for the last vehicle you bought than the first house you bought? Yeah, that's inflation. The other thing is, for the last 15 to 20 years, interest rates have been coming down. And so things like bonds and so forth have been stable, returned, pretty reasonable rates of return. We feel that interest rates are going to start going up. They have started going up. And therefore, things that may have returned bigger numbers over the last 20 years are not going to do that because the circumstances are changing. And so we're going to talk a little bit about the outlook. But again, our planning, it's not based on some crystal ball. It's based on looking at your situation, looking at the overall situation, and making decisions based on that. Now, one of the questions we get a lot is our relationship with Raymond James. In 1990, when we set up Carver Financial Services, we affiliated with Raymond James. We are truly an independent firm. So while we have access to all of Raymond James' resources, whether it's their investment banking, their trust company, their FDIC bank, we are not employees and we're not pressured to sell or do anything that they do. When we look at investments or other types of programs, we don't have to deal with what Raymond James deals with. There are Raymond James offices called Raymond James and Associates where the people are employees of the company. Whereas for us, we essentially use them to hold your assets. So when you receive your statement, when you go online and log in, you're logging in to Raymond James, who custodies the investments and who insures your accounts. That's important because it gives you independent third-party reporting. You know the numbers are legitimate because we're looking at them and they're looking at us, which is a unique situation as opposed to simply investing, and the person that you're investing with is the one generating the statement. The other thing is it does give us access to a number of resources globally, not the least of which is when we have something more technical to deal with, we have access to all of those people. So it gives our smaller office really a global reach, but we can still obviously know all of you and work with our process in terms of managing the funds, which is very unique. So, as far as the outlook, certainly the last week's been pretty choppy. People were worrying about China again. If you recall, in September, people worried about China. The market dropped pretty severely, and then October was the best month in 5 years. I think, again, it's important to understand that people worry about the wrong things for the most part. That the risk for people with us is not that you're going to wake up and the investment money's gone. We generally don't buy individual stocks. We're not buying high-risk things. You're well-diversified. That the real risks that we face generally are inflation, that a dollar tomorrow is not going to buy what a dollar today does, and we're going to need the money longer. That we have some catastrophic medical event. Particularly long-term care is the largest unfunded potential liability in the country. Or that we just make bad decisions because either we get scared and do something we shouldn't do, or we get greedy and do something we shouldn't do and chase things. And it's one of those things that anything that's too good to be true generally is. And the fact is, when people are scared, they can be compelled to do things. And one of the most dangerous products, in our opinion, are something called equity indexed annuities. These had a real push in 87, 88, 89. And then there was another push after the 2008, 2009 market. The pitch goes like this. If you buy this equity indexed annuity, if the market goes up, you go up. If the market goes down, you make a reasonable rate of return of 2 to 3%. You can't ever lose any money, but you'll participate no matter what happens. Which sounds good. The problem is, first of all, they don't go up when things go up as much as the markets do. The second thing is you're typically tied up for at least 10 years. It used to be you were tied up 20 or 30 years. So they allow you to get a portion of your money out. But as soon as you take any money out, generally speaking, you lose most of the returns. So basically, you're giving the money to an insurance company. And if you walk away, if you say, I need all of my money, the penalty can be anywhere from 10 to 30%. And because they're not registered securities, and the people that sell them don't have to be licensed, they can pretty much do whatever they want. So you hear these radio shows on Saturdays or Sundays, this radio hour or that radio hour, and it's just very, very misleading. And if there was one thing out there that really is of concern, that would be it. Because once you're in, you're stuck. If you get out, there's a huge penalty. So if you hear of something, maybe there's something we haven't heard of, let us know, let us look at it, and we can have that discussion. But again, I think sometimes there's a tendency to look for the latest, greatest, when tried and true can make a lot of sense. Now the fact is, we are very optimistic about the outlook. And it's interesting, if you look at shopping this year on Cyber Monday, was great. But when you listen to the news, they said, well, retail sales were flat. Well, that's absolutely true. The brick and mortar stores were flat. According to Adobe Research, the online sales on Cyber Monday were $3 billion. That's a 16% increase from just last year. And it's almost 100% increase from 5 years ago. Sales for the 5 days from Thanksgiving through Cyber Monday, $11 billion, which is a 17% increase. Now, the problem is, we're just inundated with so much information, and the media has a bias towards the sensational in the short term because they want you to tune in and look at things. And compounding that's going to be this election season. Because if there's not a crisis, you don't need the politicians. If everything was fine, you wouldn't need to elect them. But they're going to tell you, look at the deficit, look at the debt, look at terrorism, look at people pouring into the country. Social Security's going to collapse, Medicaid's in trouble. Vote for me and I'll fix all of this stuff. And so, we get all of this noise, and I think it's misleading at best. But it's dangerous at worst because it can distract us from an overall sound plan and make us focus on the wrong things. And again, with 2,300 TV stations and 200 million websites, you've got an election year, there's going to be a lot of noise. We believe the other thing that's important to understand is when you look at politics, the political system in this country versus the economic system, they're 180 degrees at odds with each other. Our political system of democracy says if you get the most votes, then you win. Our economic system in its purest form, capitalism, says if you make the money, you keep the money. If someone else doesn't make it, too bad. But what happens is we try to redistribute the wealth to be fairer. And the more you do that, the less efficient the system becomes, even with the best of intentions. Often the people that they're trying to help are the ones that get hurt the most because the money tends not to get to where it's supposed to get to. Now, if we look at this, again, kind of in its purest form, let's say that this side of the room makes $1 million a year, and this side of the room doesn't make anything. Now, you guys want to keep your money, and you guys are going to vote for a 80% tax. How many of you are going to vote for that tax to get some of the money? Most of you. The problem then is these guys say, you know what? We're making $1 million, now we're making $200,000. Why should we work as hard? There's a quality of life decision. The fact is, if I'm keeping most of my money, I'll work. But if they're taking all the money, I'll just work less. And that's exactly what happens when taxes go up. Tax revenues tend to go down. And conversely, when you cut the taxes for the wealthiest people in this country, the tax revenues tend to go up, and as a percentage, they tend to pay more of the tax. And it's totally counterintuitive. It's a very difficult thing to explain. But the numbers bear it out, whether you look at the Kennedy tax cuts in 1963, the Mellon tax cuts in the 20s, or when Reagan cut the taxes. How many of you remember what the top tax rate was when John Kennedy was president? It was 91%. And he cut it to 70%. And that stayed at 70 till Reagan got in office, and he cut it to 50%, and then so on. Now, they just passed the budget in November, the Bipartisan Budget Act. It did a couple things. It got rid of some Social Security strategies. You might have read about the file and suspend and that sort of thing. The other thing is that it increases government spending for the next 3 years, and then all these cuts kick in. And that's probably because these guys don't want to cut stuff while they're still being elected. But I think you're going to hear more about that, as we get into the election season. What I would say is, keep in mind, most of it probably doesn't affect you directly, so it just doesn't matter that much. So very briefly, and let me ask 2 quick questions. In the last 150 years, every time the market has gone down, has it come back up, yes or no? Yeah. And every time it's come back up, has it hit a new high? Yeah. So if that's the case, why do people worry about it? I mean, it does the same thing over and over and over. And the thing is, people worry about the same stuff. I mean, if you look at these covers, terror in the Middle East, Social Security, the federal deficit, these are all covers from the 1970s and 1980s. It's the exact same stuff we're talking about today. So I don't know that the news really changes. Again, I would encourage you to kind of look beyond some of the news and look at your own situation, because certainly more money's been lost by people trying to predict what's going to happen than actually lost in the market. We are very, very optimistic about what's going to happen over the next 5 to 10 years. And very quickly, the United States has more proven energy reserves now than any place in the world. We have some of the lowest natural gas prices. Corporate profits are at their highest levels ever. There are record amounts of corporate cash. We're the leader in the world in manufacturing. We have huge amounts of foreign capital coming in and a lot of cash sitting on the sidelines. Both the companies and the government have restructured their debt to lower interest rates, and we are also the worldwide leader in innovation. So if you look at, this is just natural gas, shale oil production In Pennsylvania, West Virginia, Ohio, and New York, it's gone up 12 times in the last, or 1,200%, just in the last 4 years with the fracking. If you look at cash, and this is one of the things people complain about, that companies like Apple and GE don't pay any federal tax. And the reality is those companies don't pay any tax because they keep all their money offshore. There is a push, a bipartisan push, to cut the corporate tax rate from the 35% it is today to 25 or 20%, which would help keep money here. But there's also a bill in Congress today to offer a one-year tax holiday for money that gets repatriated. And basically they would cut the tax rate to 5 or 6% if these companies bring the money back. And it would not be unprecedented. In 2004, they did this. They cut the corporate rate to 5.25% for 1 year, and trillions of dollars came back to the United States. If something like that were to happen, we definitely think it'd be a catalyst for very, very strong growth. The economy keeps growing. Again, we had the big dip in 2008, but for the most part, the economy's growing very steadily. Household debt in the country's been reduced tremendously since 2008, 2009. The interest the government pays is down. It's very interesting. The interest on the debt's as low as it's been since the 1970s. So while the federal debt has gotten much bigger in dollar terms, because the economy's growing and because the interest rates are low, it's really, relatively speaking, a very low number. Again, we lead the world in innovation. We have companies from all over the world coming here, and we have a record number of jobs coming back to the United States. Because it's a very cheap place to manufacture. Our labor cost is roughly half of Europe's now. And people are much more efficient. So if you look, Americans in the United States produce about 20% of all the stuff in the world. And we have 4.5% of the population. By the way, China makes 17%. So just in the United States, we make far more than they do. The interesting thing is American companies, if you look at the Apples, GEs, etc., they make between 30 and 40% of the stuff in the world. We're still the worldwide leader in manufacturing. It's because we're selling aircraft and weapon systems for tens of millions of dollars, whereas they're making lawn darts and chairs and T-shirts that just don't cost as much. And again, I think people sometimes lose this. So again, the biggest challenges we think you're going to face are inflation, medical, and making bad decisions. These are things we can talk about and we can deal with as we meet. And again, we're not going to predict what's going to happen in the near term because you can't. But absolutely, we're here for you as a team. And I'd like to take just 1 minute to introduce you to everybody in the office, and then we're going to touch on this again in just a moment. There are 3 senior advisors besides myself, all of whom are here today. Mark Spurkey, Nick Warsh, and Cale Scholes. And then we have 3 junior or financial advisors, Mike, Andy, and Greg. Just as we tell you guys to plan for the future, to have contingency plans and look at the long term, that's exactly what we're doing, bringing in really the next generation of advisors and support people. We're a company that wants to be here for generations to come. And certainly none of us are planning on retiring. None of us are that old. But in our opinion, it takes 5 to 10 years for someone really to become experienced at this. And so we're starting to build up that infrastructure. We have 2 team leaders, Bobby and Nancy, who also handle head up all the administrative and the pre-planning. We have 4 registered associates, Roseanne, DeJane, Becky, and the newest addition to our office, Sarah O'Neill, who joined us about a week ago. And they support, obviously, you directly and the advisors. These are the people you can talk to if you need a distribution, if you have money coming in, if you have questions on paperwork, you can access any of these team members to do that. We have 4 financial associates. We have Amanda, Deanna, Darlene, and Polly. And then we finally have 2 client concierge, Marge and Tracy. These are the people that you're going to see when you come in. And again, if you have things you need to deposit, you need to bring in, we don't need you to make an appointment. You can simply come in and they can help you with those types of things. You know, one of the things that's always been important is to continue to have that one-on-one relationship. You know, we know you, we know what's important to you, and to have the infrastructure available to you. But at the same time, there are a lot of things people sometimes call, so I need to speak to Mark or I need to speak to Cale, and they really don't, because it's more of an administrative thing. And the fact is, Mark or Cale or myself, we're just going to give it to one of the other team members anyway. So feel free to speak to them.
My portion of the presentation today is additional resources that we have in the office available to you, and then some commonly asked questions. And then we're going to finish up with Bobby here with some tech enhancements with Raymond James. The cost of the accounts, when we look at, and what Cale just touched on a little bit, is based on the assets under management in our office. But that also includes everything that is involved in working with us. That's coming to these events, getting the client newsletters or the e-newsletters and the reviews, in addition to the planning. So a lot of offices may charge a separate fee for the planning itself. A couple of the things I wanted to bring up today are these planning opportunities that we come across quite often, and bring them to your attention today. This time of the year, we're done with tax planning, so if anybody did some tax loss harvesting last year when the market was volatile, that was a great thing to do. But this time of the year, we're looking at people making sure that they're contributing maximum to their Roth IRAs and traditional IRAs. And then, is anybody in the room heard of a health savings account? Okay. So these are becoming really popular, and they're more for individuals that are working today. And the reason they're more popular is the deductible on health insurance plans have gone up quite a bit over the years, and most people have taken that opportunity because it lowers their current premium. Now, you have until April 15th to get money into these health savings accounts. So the advice today is, if you know anybody that is eligible for a health savings account, you can get some money in there. That's an above-the-line tax deduction, which means you don't pay any tax on the money that goes in, and any money that comes out is tax-free if it's used for medical expenses. So just keep that one in mind. And then another reminder, just April 15th is a deadline for Roth IRA, traditional IRA contributions. Another thing that we've been coming across a lot in doing this year is life and long-term care reviews. Has anybody taken us up on that offer this year? Sent us in their old policies, had us take a look at them? Okay, good. There's lots of opportunity then. All right. The reason I bring it up is, does anybody remember the old Gerber life insurance plans? Did anyone buy one for their child when they were born? Yeah, maybe? And they were really popular the 80s and 90s. Interest rates were much higher. You could get a good interest rate, a dividend on those life insurance policies. And the key was you would save up a little bit for your kids, and then at a later date they could get some more life insurance if they needed it, even if they had a medical problem. So today we found that a lot of people like yourselves may have bought them personally because they had young families, they had debt, so they needed some insurance to protect themselves just in case something happened to either of the spouses. Well, nowadays there's no debt, the kids are out of the house, and maybe there's a kid that came back into the house eventually, but there's a bunch of cash value in these life insurance policies, and your needs have changed. So what that means is, in the past, you needed a life insurance policy to basically cover if something were to happen to you, for example, pass away. But what we're faced with today, like Randy was saying, are people are living longer and longer. A lot of people don't know is you can take a look at that policy and you can potentially turn it into something that protects against longevity risk or long-term care risk. So if you are in that situation, I'd encourage you to give our office a call. It's a free review. There's no cost or obligation. We share the results with you. We present the recommendations, and then if we need to follow through with something, we'll point you in the right direction. The other key thing that we pick up in a lot of reviews now are beneficiary designations. I think everybody that's done a review with us knows that we always double-check beneficiaries because life circumstances change. But the two most important documents that you need, in addition to making sure that you have beneficiaries designated to your accounts, is your will and your power of attorney. So everybody basically has a will, but you'd be surprised, nationally, only about 30% of the people have a living will. But if I can get a show of hands, how many people here have a power of attorney? Oh man, we're doing a good job then, I think. All right, so this is another key document, and this is the one I say is probably more important than the will, because the will just says what happens to my stuff if I die and who does it go to. That's all recoverable. The power of attorney is important because if you were to become incapacitated, then you've designated somebody that can make or help you make decisions, both for health and financially related reasons. Okay? So if you haven't done that, this year, 2016, is a fantastic year to meet with your attorney. Now, it's important to note, we don't have any relationships where we're compensated when we meet with your attorney or CPA. If you do not have a CPA or an attorney, we're happy to refer you to a local one that we think that will best meet your situation. We refer people to these individuals, these professionals, based on their past experience, our client's past experience. What that simply means is if we refer somebody to them and they come back with good feedback, then we refer them again. The last point I wanted to touch on before I get onto a statement issue is Medicare, all right? If anybody's 64, maybe 63 and a half in this room, you're probably getting bombarded with mailings, and you are the post person's best friend because they're delivering about 10 pieces of mail every day for you from Aetna, Humana, that type of thing. The best piece of advice we can give you is throw all that out, okay? If you want the best source, it's from the Ohio insurance program. And it's a document that talks about Medicare, and then it also talks about Medicare Advantage, and then all the different Ohio supplemental insurance policies. So when you're about to go onto Medicare, you're definitely going to need a supplemental policy if you go with the traditional Medicare. Medicare Advantage, that's all included in the same thing. This brochure we have in the office, and we're happy to email you a link as well. You would think that they would just mail you this brochure and save a bunch of money on postage, but we're doing the opposite these days. The last thing, I'm also going to give a nice shout out to Mr. Kelly in the back of the room. This is what our new website looks like. Has anybody gone to our website? I think it's live now, right? It's live? So if anybody goes on our website here, you're going to see a different page. And the reason I brought this up to you, we've got some really neat enhancements to it. One of the things that Randy pointed out to you was the philanthropic effort over the years. This is probably one of my favorite pages. Hopefully I can show you what it looks like here. This shows you the dollars that have been donated over the years, and then again the pounds of food. And then more importantly, through the Carver Cares and the relationships that we've built over the years, all the current nonprofits that you support. And we'd like to thank you for all the support that you've done for these organizations over the year. It means a lot to the community. I think it's absolutely made it a better place. Randy told me to make sure I point out the blog. Okay, this is what's going on in Randy's mind any given day. He likes to post it there. We always read it, we promise, Randy. And then one of the newest features, because there's a lot of new faces in the office. I was one of those people in 2009, and I think there was about 9 or 10 of us in the office at that point. And like Randy said, we just hired our 19th person. One of the numbers I think is funny on the website, it says we have a combined experience of 125 years. And I was thinking to myself the other day, what if we hire 100 more people? Or we're going to say like 1,000 years eventually, and then that probably wouldn't make much sense, but we'll have to adjust it. This other one is office happenings. And the reason I bring it up is there's a strong emphasis in our office for continual education. Like Randy noted, we have a lot of registered paraplanners. I think we're up to 4. Hopefully me will be the 5th or 6th certified financial planner here in a couple of months. And we always encourage everybody to enhance their career through education. So you can go onto that page and see what's happening in the office. And with that, I'm going to pass it to Bobby, and she's going to talk about some enhancements through Raymond James.
Good morning. All right. Raymond James has added a few new features to the electronic viewing capabilities of your portfolios, as well as new methods for signing and submitting account documents. There we go. If enrolled in Investor Access, you may now customize your online view by adding account groupings, expanded summary details, and removing hidden accounts within the Documents tab. Additionally, for those enrolled in Capital Access accounts with the debit card feature, you may now elect to receive text alerts regarding transactions and balances. Raymond James has also made improvements to the RJ app with your smartphone or tablet. You can view your account summary, a detailed portfolio screen with account activity, a market snapshot screen, or use the Contact Your Financial Advisor feature. Raymond James also has the electronic signature system to review, sign, and submit required documents to open accounts. E-signature provides an easy, efficient, and convenient method for obtaining electronic signing of documents in a safe and secure environment. You may access this from your computer, tablet, or smartphone. There's no need to register an account online. The process is as easy as receiving an email notification to view the document, receive a text message to access your authentication code, review and sign the document, and then submit. The document is automatically sent to Raymond James for processing. Should you be interested in any additional details regarding these updates or any other services provided by Raymond James, please call or email any associate in our office. Thank you.
So obviously there's a lot going on, a lot of changes. As Bobby said, if you have questions on any of those sorts of things, best thing just to give the office a call or bring it up in your review. Ultimately, I think as we said, the technology is going to keep evolving, and the investments will keep changing, and people worry about different things. But at the end of the day, it really comes back to the same thing it's been for 30 years. It's all about just maintaining and enhancing our standard of living. And that's really what our process is all about. It's not about what's happening in the near term. Now, there's a couple things. Certainly the reviews, I think, are very key. As Cale said, if something comes up between the reviews, we will proactively reach out to you if there's something very time sensitive. But generally, because we're not dealing with day trading or any of this craziness, it's something that can often wait. The second way that we communicate is via the client memos. We really reduced that a little bit, so we send a quarterly memo as opposed to monthly. The website, which continues to evolve, and then through events like this. Now, all of the events that we have coming up are on the website. They're also in the annual reports that you'll find on your table. The next series of events coming up are some of the company parties that we do for Eaton, Avery, Lubrizol, First Energy, Swagelok, Progressive, Cleveland Clinic, Parker Hannafin. We have the golf event in June, which we've moved to Fowler's Mill to make it a little more cost effective. The client appreciation will be back at the Captain's. It's always fun to bring kids and grandkids and so forth in August. And then in September, we have Andy Friedman coming back. Now, we've had Andy speak before the last election, and then we also had Jeff Bush speak. He's from an organization called the Washington Insider, which is a think tank in Washington, D.C. that really follows the politics and the economics. And he really does have some very, very interesting insights, and he'll give us some perspective right before the election. So I definitely encourage people to look at that. And then we're going to wrap up the year with an estate planning update in November. Any of the events, as I say, they're on the website. You can register that way. You can call the office. We do encourage people to sign up early because what we're finding is people are interested, and frankly, we're running out of space. Today's a good example, and we so appreciate your sharing time, but you could see the number of people. So if something does catch your eye, we'd recommend you sign up. And then lastly, the same thing with the trips. You know, our trip coming up this May, we've done these client trips now for about 27 years, sold out. The next trip we'll be doing is in February 5th of 2017. It's going to be a trip to Cuba, and it's about 3/4 sold out at this point. We could take 38 people total, and we have 20 signed up. So we have space for about 9 more couples. So if you have any interest in Cuba, I'd encourage you to take a look. You'll be receiving some information in the mail in the next week or so. But our goal was to get there before it got kind of ruined by the cruise ships and everything else. But the client trips are just a fun way to interact and hopefully see some things. You know, our goal with the trips has always been to offer an experience that you wouldn't or couldn't do on your own. And so a lot of times people ask why we don't do certain things. If it's something you could do easily on your own, we're probably not going to do it. On the other hand, if you have a great idea, let us know, and maybe we'll do it. And that's where the Cuba idea came from. We had a number of people ask us about that. So with that, before we wrap it up, are there any questions that Nick, Gail, Bobby, or myself can answer at this point? Yeah, David.
What's a 702J?
What's a 702J?
You heard of that?
I have not heard of that.
I'll get some information for you before we talk about it.
We'll talk about it Monday. I guarantee I'll have information Monday.
Have you heard about it? No?
Anybody heard about 702J? I think it's one better than a 701J. Anything else? Okay, well, we'll be around as well as the other advisors. We'll be here if there's anything we can do. Again, we appreciate your coming out and hope you have a good weekend. Thank you.